Okay, now we're going to demonstrate how we record business transactions using the journal, and then how we classify them and summarize them by posting them to the ledger. First of all, the journal. Riveria Theater was recently formed. All facilities were completed by March 31st. On April 1st, the ledger showed the following balances: cash, $6,300, land, $10,000, and so on. The first thing we must do is enter them in the T accounts. Now, I have done that for you. Now, secondly, it says, journalize the April transaction, including explanations. And we start with April 2nd. Paid film rental fee of $800 on the first movie. So, April 2nd, debit, rent expense. Now, notice the debit is very close to the line here. $800, because rent expense went up and expenses increased on the debit side. And I paid cash, so my cash went down, so I credit cash $800. Cash is an asset, and it decreases on the credit side. April 3rd, ordered 2 additional films at $750 each. Now keep in mind we're recording business transactions here. Transaction is an exchange. On April 3rd, no exchange has taken place. This simply ordered 2 additional films. We haven't received them, we haven't paid for them. So this is not a transaction. So we move on. April 9th, received $4,700 cash from admissions. Now we are a theater, and that's how we earn our revenue. And so therefore, on April 9th, we earned revenue. And the way we would record that, the date, the debit first, the debit's always given first. Debit cash, $4,700, because I received that in admissions. And credit my revenue account. In this case, it's called service revenue, $4,700. Okay, now, April 10th, I paid $2,000 of the mortgage payable and $1,200 of accounts payable. I paid cash. So this transaction affects 3 accounts. The 3 accounts are mortgage payable and accounts payable and cash. Now, mortgage payable went down $2,000, so a decrease in a liability is a debit. So I debit mortgage payable $2,000. Accounts payable went down because I paid it off by $1,200, and a decrease in the accounts payable account is a debit. And the credit is cash. Now, I forgot I should be making explanations here, but what we could say is paid down mortgage, and accounts payable. And accounts payable. Okay. Now, on the 11th, I hired Mr. Gavin to operate the concession stand. Gavin agrees to pay the theater 17% of gross receipts, payable monthly. But here again, like April 3rd, this is not a transaction. I just hired somebody. They haven't worked for me. I don't owe them any money. We just have an agreement. And in accounting, we only record business transactions. So this was not needed to be recorded. So we move on to April 12th. Paid advertising expenses $410. Expenses are always debited. So I debit advertising expense $410. And I paid cash. So my cash went down. So I credit $410. And I would just say, as an explanation, paid for advertising bill, I guess. We can just say paid advertising bill. All right. Now, on April 20th, I received one of the films ordered on April 3rd and was billed $750. The film will be shown in April. Now, this is a transaction. I received it, and I was billed, so therefore I owe it. The journal entry then is debit rent expense, always debit expenses, $750, and I haven't paid it. I owe them because I have an account with them, so I credit accounts payable, $750. On the 25th of April, I received $3,000 cash from customers for admissions, same as the one we did above. Journal entries begin to repeat themselves because the same transaction repeats itself. So April 25th, I received cash, so debit cash, and I earned revenue. And every time you earn revenue, you credit service revenue. And the explanation is receive cash for admissions. On April 29th, I paid on April 29th, I paid salaries of $1,900. So it's debit salaries expense. $1,900. And I paid it, so it's credit to cash. $1,900. And I just have to say paid salaries. Of course, I paid salaries in cash. Okay. And the last one, the second last one, I received statement from M. Garva allowing showing the gross receipts of $2,000 and a balance due of $340 for April. He had gross receipts and he owes us $340. He's going to pay half now and remit the rest. Okay, now in this one, we received cash. We received $170, so cash goes up $170. He's going to owe us the balance, which is $170, so debit accounts receivable $170. Now this is revenue, but it's not admissions revenue, it's concessions revenue. So instead of using the account service revenue where we provide service, this is revenue we've earned as a commission on sales. So we're using an account called sales revenue. We can have two revenue accounts. And that sales revenue account is 17% times the $2,000 or $340. And the final transaction then is I prepaid $1,200 rental on a special film that will be run next month in May. So now we prepay for a movie. We haven't received the movie yet, we're not going to get it. But we prepaid for it. So that is an asset. And we call that prepaid rent. And because it's an asset, it increases on the debit side. And I paid cash, so it increases on the credit side. So there you have a number of transactions for a theater company. And we demonstrated how we use the general journal. Notice the debits are always done first and recorded next to the line. Then we indent and record the credits. Notice every journal entry, the debits equal the credits. And that's how we do that. Now, in the next video, I am going to demonstrate how we transfer the data from the journal to the ledger. And that will be the next concept video.